morning. I can recognise a few faces from last night. Always those sorts of things always remind me of a joke. And that's being a tax accountant, you sort of have to have a few tax jokes at your disposal. And that is, what did the tax accountant do to make the Christmas party more fun? He didn't go. So I was thinking perhaps I should have stayed at home. Anyway. So we're going to be talking about a number of things today. There's a lot of material. Quite happy to take any of your questions. It might be that we run out of time, but we'll be certainly hanging around at morning tea if you'd like to, if any of the more technical questions. I know there are a few people who approached me last night. Needless to say, I'll put them off. Anyway, so today we'll be talking about FBT, we'll be talking about GST, and actually one of my favourite topics is a bit of the scuttlebutt and the gossip around the tax office and the way that they're actually dealing with government in particular, especially in these times where they've just lost 20% of their staff. So we'll be talking a bit about that. But normally I would start with that, but given that yesterday was FBT Return Lodgement Friday, I thought I might start with FBT. Now, who lodged their returns yesterday? Who hasn't lodged their returns?
I've got an extension.
Oh, that's right. So it is a bit, look, to be honest, I really don't like FBT. I don't mind charging a lot of money to do FBT because I think I deserve it. It's extremely technical. It's inconsistent. It's badly drafted. It involves a lot of administration, and because you only do it once a year, you forget everything. Anyway, so we'll just talk. What I'm going to be talking about today, it is fairly high level, but it's actually, I'm not going to do a whole technical thing about FBT, but more about the things that I've seen, having done a number of FBT reviews of councils recently, where the issues seem to lie. Just those sort of little marginal issues that people are still struggling with. Okay, now just a quick update. As a result of the, the budget rescue levy, or whatever they call it, the rates are actually moving around a little bit for the next couple of years, only the next two being going from 47 to 49, then back to 47. Importantly, of course, that means that your gross up rates are changing, so you've got to make sure that all your spreadsheets are updated to account for this. And the thing is, of course, it's only for 2 years, so it's got to keep in mind that. Okay, so one of the main ones that look, to be honest, there's not much living away from home around anymore, simply because it just isn't the concession it used to be. I know when Peter and I were working at PwC, about 50% of the people that worked there on some sort of laugh or, being POMI management consultants. And then as soon as they got rid of the real concession for non-residents, they all went home, which is quite funny. Now the interesting thing is that now the transition period ended as of 1 July 2014. That's handy, isn't it? 1 July 2014 from fringe benefits point of view. So unfortunately for those of you who does anyone play a laugher? Here? Nobody? Okay, we just seen a bit of it around, but still. It means that of course you had to have 2 periods. One from 1 April to 30 June and 1 July, which was now subject to the new rules. The new rules are a lot tighter. Basically, it's only available to residents now. The resident needs to be maintaining a house that they can return to at any time. So that means that as soon as you start renting out your house because you're away, that means basically the lump is no longer available. The one that seems to get people in trouble too is that it can only be for 12 months at a time. So if you do have staff that's actually moving around, that seems to be okay. Say 3 months here or 3 months there, but otherwise you can't actually make use of the concession. And they've really ramped up the substantiation requirements. So you need a declaration every year saying that they have that they've been moving around, that they have maintained a residence. For all accommodation, full substantiation. That doesn't seem to be a problem because most people are doing it through credit cards, corporate credit cards anyway, but The main thing too is the food full substantiation is also required, especially where you're actually spending more than the statutory threshold. Now the main, I guess the take-home message with LAFA is that it's really important to distinguish between benefits that relate to relocation, where you're actually doing a permanent move, to those that are actually living away from home allowance, keeping in mind this 12-month kind of guide. And also, it's amazing how many people actually don't distinguish between travel allowances and LAFA. So travel allowances, of course, can sometimes be subject to PAYG, where LAFA benefits aren't. So it's always, keep that in the back of your mind when you're actually dealing with travel allowances. Okay, motor vehicles, obviously, hallelujah, we finally got to a flat rate of 20%. So we don't have to worry about mileage anymore. We don't have to worry about whether or not there's new commitments, which of course was certainly a big deal with state government departments where they tend to have lots of machinery for government changes. Now it's all a flat 20%. Did everyone find that a lot easier this year? The main thing, of course, you don't really have to worry about logbooks, which is always a real issue. Your odometer readings aren't quite as important. But of course, it's always useful to have those sorts of records anyway to keep everyone disciplined. The fleet managers probably know too. Now, entertainment. Now, this is always a curly one, and particularly when you're dealing with counsellors who may well like their finger food and their little tipple. Now, the biggest issue I've seen in terms of entertainment, councils generally are very good, and generally have very strict guidelines about the sorts of things that you're providing the public and your counsellors, or whenever you are actually entertaining. The difference, or the problem seems to be where you have an employee that actually attends those functions. Now, there seems to be this sort of myth and legend, smoke and mirrors, that if an employee is attending and is actually working, regardless of what's going on, that employee, that's actually not regarded as entertainment benefit. However, that's simply just not the case. So generally speaking, under the tax-exempt body entertainment rules, generally speaking, if your employee's the entertainment is incidental to the provision of entertainment to outsiders. I love that. That's actually a technical term used in the FBT Act. It's limited to light refreshments, or in fact, it's a recognition of a special achievement of the employee. In that case, it will not be entertainment. However, if you involve a meal, you involve any sort of other sorts of entertainment, whether that's theatre or dancing or whatever, anything like that, you're in trouble. So you really need to be keeping an eye on entertainment, even if you're doing 50-50. Okay, another one that I come across fairly regularly is loan benefits that arise as salary overpayments. Now, thankfully, generally speaking, that won't give rise to a loan fringe benefit because of the rule of thumb and the mine benefit rules. So if you've got $5,000 that you've overpaid, you've probably got a problem. The interest component relating to that loan is actually at $300. But generally speaking, the tax office is quite happy that those sorts of benefits are actually can be minor benefits. The only thing is, of course, sometimes they become reportable. Now, the other problem is debt waiver benefits. So, of course, if you've got an employee who's been terminated, you may well have a policy that you're going to try and recover that salary overpayment from that employee. The point is, though, that as soon as you decided to write it off, you then have to decide whether or not it's a debt waiver. Now, the problem with debt waiver benefits, it's not just the interest, it's the whole loan or overpayment that's actually subject to the benefit or treated as a benefit. Now, thankfully, the tax office takes a fairly practical approach to this, which I think is fairly reasonable. Now, if it's not commercial for you to actually pursue this employee, and I've had lots of examples where they bugger off to the UK or something, and basically makes it impossible to recover that loan or overpayment,
that won't actually be regarded as a debt waiver. But the important thing is that you've documented that, and you've got actually a policy in place that talks about waiver, debt waivers, or the fact that you're writing these salary overpayments off. Okay, remote housing benefits. Now, interestingly, councils still seem to pay these, and in fact, it seems that it's quite a well-used benefit. Does everyone, we've got people here who use remote housing? Yeah, it's actually a really good one. I guess the big difference, I guess, and I still have to go back to the legislation every year and have a look, is the distinction between the actual housing benefit, which is completely exempt, versus the 50% concession, where actually it's more like an expense reimbursement. Okay, so just to go over that, if the council owns or has a lease in its name of a house, and you're actually obviously you're in a remote area, that will in fact be completely exempt. Okay, but however, as soon as you start paying mortgages or you're paying rent on your employee's behalf because they've actually entered into a lease agreement themselves, that's actually the 50% concession. The beauty of it, of course, is that you can do utilities as well. Oh, car parking. What a frightful benefit. I really don't like this one, but okay, so car parking, and this is another area that I see that people struggle with, and fair enough, I reckon. It's really tough. Okay, so what is a car parking benefit? So the car is parked on business or associated premises. Okay, so that means that it's owned, leased, or under the control of the employer, so it's on your premises, or it could be something that you lease that's in a shopping centre or another building. Okay, or it can be a car space that's actually leased by the employer on behalf of the employee. Okay, over 4 hours between 7 a.m. and 7 p.m. Now, that one's an interesting one because it doesn't have to be a business day. So I know there's a few councils and government departments I deal with that actually don't offer car parking during the week, but if employees come in over the weekend to do overtime, for instance, that's where they can get pinned. And if you've got 13 car parks and they're all full over the weekend, that can actually quickly spiral into a benefit that involves a fair bit of tax. Commercial car parking station with 1 kilometre radius. It's funny how Google Maps can be pretty useful in those circumstances. I've actually seen people with a clicker and those clicker things. But you've just got to make sure you've documented. I think the tax office used to be a bit thingy about what was 1 kilometre and using Google Maps, but it seems that they now understand that no one's going to be going around with a clicker. Okay, the employee owns or leases the car. So this is good because of course it means that none of your pool cars are going to be a problem. Any council-owned vehicles are not going to be subject to car parking benefits. Another good one, car park is in the vicinity of the employee's primary place of employment. Now that means if you've got a couple of offices around the place, and I imagine some of the regional councils do, if you're just visiting, doesn't really matter how long you're there, it's not going to give rise to a car parking benefit. Now this was one actually Gary Green from Liverpool last week to deal with, and he's not here. So a car parking benefit cannot in itself be an in-house benefit. Okay, so whilst your council might be in the business of running a car park, it can never be an in-house benefit, which is of course concessionally treated. So the problem with it is that an in-house benefit needs to be an expense, a property or a residual benefit. Now, because a car parking benefit is actually its own benefit in its own right, it can never by definition actually be in-house. However, that doesn't mean, and I haven't written something, doesn't mean that if you meet the expense of an employee in respect of a car park which you own, so that you invoice the employee and then you pay that invoice, that in my view can still be an in-house benefit. That's why I didn't write it down. So to get my point, so for those of you who might be treating car parking as an in-house benefit at the moment, perhaps it's time you to think about the way that you structure that and turn it into a car parking expense reimbursement benefit. Okay, well, that didn't take long. Dispense with FBT.
Okay, so GST, there's been a fair bit of movement going on here. Oh, actually, before I move on, the other single most sort of tricky issue we've come across every single time we've done FBT reviews for councils, and that's how you deal with contractors. I know it's boring, I know it was on the audit office list for a long time, but it's really important, simply because of the superannuation aspects, that you have a proper framework by which to assess whether you have a long-term contractor who may well be actually an employee. Do people usually go through with some sort of contractor checklist? You have a contractor checklist? Just those sorts of things will make it look better in the event that you have a payroll. I know the Office of State Revenue are putting off the payroll tax, don't have to worry about that so much, but just having that framework in place, a checklist, there's actually one on the tax office's website. For every single employee who's providing personal services, you should actually get your HR department to go through that exercise to ensure that you are actually dealing with an independent contractor and that there isn't any other nasty tax surprises associated with using that person. Okay. So what's going on? So that's it. I want to talk about GST and tax governance more generally for councils and government. Because of all the different things that are happening at the moment. The tax office has introduced a number of new products which you should be aware of and understand exactly where you're actually sitting in terms of these new assessment products. I'll talk about that. Okay, so what's happened? The tax office has lost nearly 5,000 staff. By the end of June, they will have lost 5,000 staff, which is over 20% of their agency. So, and I'll talk a bit more about what that actually means and how they're going to approach compliance and general risk assessment. They no longer have dedicated government or not-for-profit teams, which I guess is a good thing in a way, but it's also really painful when you have a particular issue that is always, government and councils have got its own unique issues to do with tax. It's really difficult now to find someone in the tax office that you can actually talk to about these issues. I think there's only, Pat McCarthy and I were having a chat last night, I think there's probably only Marty Lyons in the tax office now who actually takes responsibility for government, where we used to have state-based government, specific government liaison people. So it just makes it a bit more painful. If you've got an issue, you can't really go to anyone in particular anymore. The resources, and particularly around specific reviews and any sort of audit activity, is actually allocated as per the taxpayer risk differentiation framework, or the RDF. And I'll talk about a bit more about that, where councils are likely to sit in that in a minute. And they are putting huge investment. What they're not spending on staff, they're now spending on data matching tools. Okay, so it's more likely, rather than someone just ringing you up about a specific review just because of a particular technical issue that might be going on, you're more likely to hear from the tax office because of something they've seen in your data. Right? So you've got to be very conscious of the sorts of numbers that you're actually entering in, because it could well be that you're triggering a red flag. Now, the thing to do that in those cases is that you're proactively managing the tax office when that's likely to happen, because you know something's coming up. Okay, so government, of course, you've got reduction in your budgets, your back office staff, you've got less and less resources that can be dedicated to tax. Now we are right in the middle of a self-assessment regime now. It used to be that the tax office was responsible for assessing, but no, that's now very similar to corporate tax and income tax, to the extent that you are responsible for taking technical decisions. You've also got the taxable grants and payments reporting regime. Is everyone aware of that? That you will be required to start feeding into the tax office information regarding grants that you pay and a number of other payments. Now this is actually going to be a really big task, getting that sort of information in the way the tax office wants it into the tax office.
And interestingly, it seems in my experience that nobody really knows much about it. But keep an eye out for any sort of correspondence regarding that new regime, because it will mean that the way that you interact with the tax office will actually change. And when all of this is said and done, the tax office gets up and makes presentations and says that it expects government, despite all of these things, to be the exemplar. You should be the role model for your corporate cousins, which I think is highly hilarious given that the tax office itself doesn't do a great job at tax compliance itself. Okay, so and then not-for-profits are in a similar boat, and I thought I'd add them because of course you'll be providing funding to various NGOs and that sort of thing. So all the concessions that were available are still technically available, but they're treated like any other taxpayer. There's no soft touch on NGOs or charities and not-for-profits anymore. And of course we've got this confusing time that we're not really sure what's going to happen to the ACNC. Okay, so as what I mentioned before, of course, was the fact that they've introduced this risk differentiation framework. Now, what that means is that every taxpayer is actually thrown into a huge bucket and put through the tax office's new improved sausage machine. Okay, so instead of you being government and everyone being everybody else, you're actually assessed in the same way as any corporate taxpayer. Okay, so depending on where you sit in the risk differentiation framework, will define if, when and how the tax office are going to interact with you. So it's really important for you to know where you actually sit, because then you know what to expect when it comes to the tax office. Now, most of this is the very first feature, which will define where you sit within the RDF, is based on what they call your throughput, okay, which isn't actually turnover. It's actually, they look a lot at credits, but of course they also look very carefully at what you put in G1. Okay, so I guess this is a good time. If you, as you probably know, where you receive appropriations and grants that you are treating as exempt from GST, okay, or out of scope, because of section 917, they do not belong in your BAS return. Okay, they shouldn't be coded as GST free, right, or anything else. So if you're receiving large funding streams that you are currently putting in your BAS but aren't paying GST on it, then they should not be in your BAS. And now, no one's ever really worried about this. There's just these enormous numbers that sit in your BAS that don't actually have any GST implications. What that will mean, if you're overstating your funding for GST purposes, it means that you might, in fact, get onto the tax office's radar, okay, simply because you've got this big number that shouldn't actually be on your BAS. Okay, so I'll keep saying that it looks better if you take those big funding streams out, and it will mean that the tax office might leave you alone. Okay, and the other thing they're doing, focus that if you are going to have a specific review, a lot of stuff that we do see, if it's not on one particular issue, like an item 4 issue, which I'll talk about in a minute, it's actually running through your data. They'll look at your business systems, they'll look at your how you've implemented Tech 1 or whatever finance system you're using, and see how compliant it is, and importantly, how it talks to the other systems that you might bolt onto it. They also have data matching and refund integrity, as I said, little red flags. And they also have a look at complex and unusual transactions. Now, unfortunately, the tax office can read. It does actually look at newspapers. It will take notice of media releases. So if you are doing something that there's a lot of hue and cry about in the community, more than likely the tax office will get onto it eventually. That's certainly a few inquiries I've had done where the local papers have been talking about some relationship you might have with corporates. Okay, so here it is, the RDF. Okay, so we've got along the what is it, X and Y, I can't remember. Maths was a little while ago. So we've got the lower risk taxpayers, of course that's where you want to be. We've got key taxpayers. Now key taxpayers you will be assessed as a taxpayer, where your throughput, as I said, which is a concept of revenue and expense in your MES return, based on that you may be a key taxpayer. So large councils could well be a key taxpayer simply because of the size of the money going through your organisation. Now along the x-axis, the medium risk taxpayers, that generally is that you're not necessarily very big, but you have to deal with particular issues that are tricky from a GST point of view. So if you're undertaking large property developments together with a property developer, that's when you could end up being in a medium risk taxpayer category. And then there's the high risk taxpayer. So we'll never have a council in there. They tend to be the banks and other dodgy ones. Okay, so when we talk about what complexities and risks are a focus for them at the moment for the tax office, okay, so governance, so it's all about this tax management and the integrity of business systems, so making sure that all your business systems are as hard-coded for taxes as possible, those sorts of things. Yet again, the appropriations and non-taxable grants issues, so what's in your BAS, what are you actually treating as GST exempt as an appropriation. RCTI arrangements, do you guys use, I've got recipient created taxing, yep. They're very useful. It's still on the radar for the tax office, and I think the main problem is that you might have your agreements in place, you might have proper invoicing and all of that sort of thing. The problem is it seems that a lot of councils aren't really good at determining whether the people are actually receiving the money and registered or not. So you might well be claiming credits happily on your RCTI agreements and on your invoices, but there's no GST actually getting to the tax office on the other end. So in terms of managing that risk, you've got to just make sure that not only do you have it in the agreement that they're required to be GST registered, but you also do that ABR check before you enter into that agreement. Now, of course, this is one of Pat and my favourite little ones. Item 4 on property dealings involving unimproved land. So Section 75 of the GST Act has this fabulous concession available to government regarding though land held at 1 July 2000 that's unimproved, or in fact at the time of sale it's unimproved. Generally speaking, if you do it well, you can the effect of it can be that you can reduce the GST on your sales of land from say 8%, which is 8.5%, which is usually what you can get under the normal margin scheme. You can get it down to as low as 1% and 2%. So it's a really significant concession if you've got a good valuer. Now, needless to say, the tax office isn't very happy about that. So, funnily enough, it has decided that the whole notion of unimproved land is not what your valuers and the whole of the valuation industry would regard as unimproved land. It's something a lot stricter. Now, interestingly, also, because it's only available to government and to councils as well, any tax on property is actually unconstitutional. So Section 114 of the Constitution doesn't let the feds tax the property of the state. So all the states actually entered into an agreement when GST came in that you would pay a notional GST with respect to property. Okay, so by the looks and feels of property tax on property, it would feel the same, but in the end it's notional. So what does that mean? Yeah, you go, okay, we do that. The problem is though, because it's only a notional tax, all of the objection rights, penalties and interest and various other things that are actually applied by the Tax Admin Act don't apply. Okay, so the interesting thing about these item 4 issues, which are very big and can involve a lot of money, you can't actually object and appeal or in fact take the tax office to court. So what they've done is set up what they call an alternative dispute resolution process, or an ADR, which they've set up basically as a conciliation, where they've got some old judges who are residing over these issues. Interestingly, They've also said that the tax officers said, yes, okay, we've got this process, but we're not going to regard that as having any precedential value, except for the fact that they just had their first one. It was favourable to the tax office, and now they're saying that they want to. Suddenly it has become very precedential. So item 4 is becoming very interesting. Now, is anyone using the item 4 concession at the moment? If you've got large estates, I imagine that you'd be aware of it. Yeah, it's okay, but just to keep moving, corporatised privatisation. I guess obviously machinery of government changes. They'll be watching councils very carefully over this merger exercise, just making sure that all the tax aspects of that are actually captured. And the introduction of large delivery programs. So generally that would be a statewide thing across councils, I guess, but just be aware that that would be something that the tax office would be looking at. Okay, I'll just whip through this. The government governance program. So the tax office is saying that because they have noticed that because government councils and the like are more resource poor, and especially in the back office, that councils and government are getting a little bit more innovative, I think was the word that they use. Now, they have been rolling out a governance checklist program where agencies or state agencies and territory government agencies have been required to fill out a particularly onerous checklist about the sorts of governance framework and risk management you have in place for tax. My understanding is that they haven't done it to the Commonwealth, and I haven't heard that they're going to do it for councils just yet. I think it's just too big an exercise. But it may well be that you need to have risk management, governance, and all of those sorts of things in terms of your procedures and controls. They need to be in place. Okay, so the elements that they'll be looking at: governance, procedures, processes, resourcing, all the stuff that you expect. I've included the website reference there for you to have a look at. Not a bad thing to do if you've got a spare 5 seconds, to actually have a look at that checklist and self-assess as to what you think, how your council might actually sit. Okay, just now, as I said, appropriations and non-taxable grants. I'll just go over the technical aspects of that again for you. Okay, obviously where it's an appropriation under 917, used to be 3C, it's changed. The great part of that is it's become a lot less strict about what you can actually regard as an appropriation. But as I said, don't put them in your BAS return. Make sure that they stay out, because you don't want to end up being a key taxpayer, when in fact you should be a low-risk taxpayer. Okay, that's why it's still seen as a significant technical and reporting issue, because it's actually inflating the numbers that should be in there. Okay, as I said, not GST-free. I think I've honked on about that now. Enough. Now, yeah, the one point I would like to make, if you are going to have a visit from the tax office around this issue, the one thing they will do, they'll go straight to your annual report. So, to the extent that you've got your grants and funding in your annual report, you'll need to be able to reconcile it and your treatment of those to what you're actually doing as. So to the extent that you are including certain things in there because you're regarding them as appropriation, make sure you can reconcile that. They're the questions that they'll ask, especially with this data action regime. So said 917, I won't talk too much about that, other than that they changed it recently. It's a lot less tight than it used to be. They've given meaning to a non-commercial test. So it also means that a lot of shared services and things like that, where you're actually receiving other things from government departments. Now, it seems, after ATO ID 2013-54, it looks like things like secondments and other services may well be regarded as appropriations. I'm not sure, the tax office isn't real happy with that, but if you actually apply the non-commercial test, and in fact the agency that's paying you is actually government, and you both core budget, in fact that you're funded for that sort of thing. You have a look at ATOD 2013-54, that in those circumstances, even with an administration fee, that could well be out of scope. Okay, grants and RCTIs, as I said, I've probably talked enough about that. Just be very, make sure you have an additional procedure where you actually look at your RCTIs and make sure, have a look at the ABR and make sure that your grant recipients are in fact registered. Talked a bit too about the property of unimproved land. So I said there's two circumstances in which that arises. There's margin scheme item 4, where the land has been subsequently improved. So in the end, a lot of that is about whether or not you have photographs and aerial representations of your land at 1 July, whether it's got trees on it. That's what it can come down to. As I said, the tax office is getting very strict about what unimproved land is, but it's worth a crack. There's lots of money in it. There's also the GST-free concession, which means that it's unimproved at the date of sale. Okay, so I've probably talked enough about that. Okay, other complex transactions. Now, I can't tell you, I'm more than happy to talk or take questions about general things that you might be entering into, but it seems to me that councils, and as with many organisations, if you're actually entering into something, often you see the council will actually rely on the other side's advice. So they'll ask the question, the other side will actually say, well listen, I've got a ruling, I've done this before, and I'll show it to you, and all of the stakeholders actually rely on that advice. Now, of course, that's one, it doesn't provide you any protection whatsoever because of course it's been issued to the other side. Two, in my experience, not everyone's working in the best interests of council when you're in those sorts of situations. And obviously sometimes it comes out of the wrong outcome. It's always good to get your own ruling if you've got a complex transaction. Okay, so the takeaway, tax, as I've always said, tax technical risks and issues for government are constantly moving. They're not getting less. If anything, they're even more under-resourced than they ever have been. I think that we can navigate our way through this, provided that you have your procedures and controls in place around compliance and, importantly, risk management. You've got to make sure that the responsibility for tax sits at the right level in the organisation. You need to have a CFO who is the owner of tax risk. You have to have appropriately qualified people. We're seeing that the tax office is now decreasing its resourcing, so it's going to be increasingly relying on these data management and more general governance tools. So the questions that you're going to be asked may not be specific about a big technical thing, it'll be about some little red flag that's gone up in the tax office. So, but generally we want to say, we need to continue to resource tax. We need to resource it wisely and with intent to make sure that at least the perception of the tax office is that you know what you're doing. And I thought I'd just put this at the end. So this has been, not sure how excited anyone was about the budget announcement, unless of course you've got your own little small business that you might be rushing out and buying your $20,000 worth of IT or your new ute. Apparently the utes are all worth $19,990 at the moment, as is your television and entertainment packages, apparently. The only other thing I thought you might be interested in, that I do a fair bit of work in the health and PBI and charity space, is that they've now capped the meal entertainment benefit concessions. So to the extent that you're dealing with public benevolent institutions or charities, that very lucrative meal entertainment benefit where you had doctors who were funding their daughters' weddings, etc., tax-free, has now been capped at $5,000. So now they'll only have to have a tent out in the backyard. Oh well. Yeah. Anyway, that's probably all in terms of, we don't have much time, but if you've got any questions, we've probably got about 5 minutes. Don't make it too curly. I just
private ruling, apply for a private ruling and they give you a time that it expires, should you be, making a note somewhere and actually getting another one when it has expired, or can you rely on the precedent that was set from the original ruling?
Once it's expired, so it actually offers you no protection. So my suggestion would be, the fact that you've got it generally means that when you actually apply for another one, it's going to be really quick and easy. So yeah, I would always get a new one. And even if you have to retrospectively apply from the date that it expired.
Thank you.
One of your earlier slides about grant payments, some sort of register you were saying that you really should be keeping. Are you talking about grants received or grants if you pay them out?
Both.
Oh, okay.
Okay, so that helps with the reconciliation exercise I was talking to you now. You should have, if you are CTO agreements, you'll have to have, you should have a register for both funding and what you're paying. And just so that you can say, okay, that in terms of your annual report, that's got to, that's in my BAS and it isn't. That'll become even more important when the new taxable grants and reporting regime comes in from July 2016. Any more questions? Anybody? Oh, it got off lightly. What a relief. Tell me more.
Well, and they said that they'd get back to us.
Oh. I know they've extended
within
it.
2 or 3 weeks, but that was in September last year. Have you heard anything in terms of what's going on in that space?
All I can tell you is that no one really seems to know anything about it. They're still collecting, they're still going through a consultation program with some of the larger government agencies, I think. I know that Treasury's been issuing some letters saying it's coming, but I really don't know that the tax office has any clue about how large an exercise this is going to be.
Because it's going to be like an ongoing regime, a yearly compliance.
Oh, absolutely. And it just means that, of course, a lot of the reporting burden that the tax office currently has is actually outsourcing.
Yeah, they're laying off their staff.
Yeah, exactly. And you're supposed to be picking them up. I think so. Yeah, to be honest, I'm obsessed with MAs. No one seems to know anything about it, least of all the tax office, who, I might add, are still struggling with a few of their other new reporting regimes like SuperStream, where a lot of finance systems aren't coping very well with it. The irony is too that a lot of the financial systems providers won't actually act on any of this until it becomes law. Of course, they usually do that in about 24 hours before it's due to come in.
It is quite hard to prepare until you know exactly what's involved. We don't want to chuck a lot of resources or something. It could be like Special Schedule 7 where it's rolled out over a number of years.
Yeah, I don't think it's going to happen on July 2016. Or they can say it is, but I don't think anyone will actually do it.
Okay, thank you.
Doesn't seem that there it is. We often get phone calls and data matching requests from the ATO for GST, but it's been silent for decades on FBT. Is there any movement on audit increases from the ATO with regards to FBT?
The only audits that I'm hearing about, funnily enough, is around contractors. That's probably why I raised it again. But yeah, it's been quite quiet for a long time. I don't actually know where their FBT audit effort is being devoted. You're absolutely right. The other thing too is that they obviously don't have the systems to do the data matching for FBT. Yeah.
Yeah.
Hi, in regards to the margin scheme, is there any sort of a simple to follow flow chart in order for us in local government to determine when to apply, what rules and what information we need to inform our bailiwicks as to what they need to provide?
That would make it easy, wouldn't it? Wouldn't it be marvellous? Not really. There are a number of rulings from the tax office itself. I'd take a lot of it with a soap, as I said, they tend to have taken it too far. 2006. Which one is it, Pat? 2006. Thank you. I'd be having a look at that. But you also have to be aware that there's also a number of determinations around how you value, what is acceptable as a valuation, who you need to do the valuation, and when you need to get the valuation done by. I think it's 2009. Is it MSVD 2009?
MSP 2009.
Thank you. Look, they're fairly technical in the sorts of things, documents. Just thinking where else you might look. You can go to the legislation. Say we're looking at section 75, and it has a table there with all the various items. And we'll be looking at item 4. There's also section 38445, which is around the GST-free sales. It's absolutely worth familiarising yourself with those. Sorry, I can't put my whole foot in there.
You know, it's all right. I've just had differing advice from our auditors, and I just wanted to get it clear in my head so I don't need to keep going back to them to get.
It's always good. Not to be going back to your auditors too much. Never mind. Wait, come and see me after. Okay.